Well, welcome to the Soybean Board's weekend commodity wrap up. I'm Clay Patton in for Susan Littlefield. Hey, thank you to the Nebraska Soybean Board for their continuing support of this program. Have two of the best, though, to talk a weekly market trade. That includes Kyle Bumsted of Allendale and, of course, Brian Splitt, agmarket.net. It's going to be a wild conversation, supply versus demand. Can the bulls keep outweighing the bears on the grain side of the complex? What about those currency markets? Been a wild ride in the U.S. dollar. And, of course, the cattle market starting to heat up here at the end of the week. We'll have that and much, much more right after this.
It may be small, but this little bean fuels a lot of power. It powers a food industry as a top source of protein. It's a fuel that powers diesel engines with fewer emissions. It powers a state economy and bottom lines. And it powers the rest of the world as a top Nebraska export. Yeah, it may be small, but we're finding more ways for this little bean to power Nebraska.
And welcome back here to the Nebraska Soybean Board Weekly Commodity Wrap-Up. Again, Clay Patton in for Susan Littlefield, taking a much-needed vacation. As we have both Kyle Bumsted and Brian Splitt joining us today. Men, I start us off in more of a roundtable format. It's been a wild week on the grain side of the complex, but I go actually back even to last week in that WASDE report where we had the supply bulls really starting to pull us ahead, but macro market factors and concerns about global recession pulling away that demand destruction seemingly to ever be in that rear view mirror. Coming in here towards the end of the week, what's your thoughts? Are the supply bulls still winning out, or are those demand bears about to take back over?
I'll start here first. We've got a pattern right now on corn specifically of making highs on these WASDE reports, and thus far the high on the report that you spoke of is still intact. The market does think that the crop potentially could get smaller. That would be the history based on what we have seen in previous years. When you see the crop size reduced in September, generally you'll see it get smaller again in October. But we just can't ignore the lack of exports. Exports are down 50% year over year. And when you look at everything that's happening in the outside markets, especially when the equities with interest rates going up, I tend to think that we're right around the corner from having some more harvest pressure. We just don't have enough harvest underway yet to get that. But I think as we start getting this crop with where basis levels are, where cash prices are, you're going to see some pressure come in here. And I think if you're not willing to part with your grain, especially if you're really just waiting to see what kind of yields you have to be really looking at puts. If December corn breaks through 670, I think you're going to have some substantial downside corrective action as we get towards the end of the quarter into October. Let's not forget that we also have that period for fall price averages for crop insurance. They're about $1 higher than our spring price average. So if you have that potential right now of having an insurance claim, your risk is the market going down during the month of October. And I think you have to protect that.
And Kyle, I turn it back to you as well. You can see both the supply and the demand straight out your window, feeding cattle with cornfields right next to them. What's your take here in the current supply-demand struggle?
Well, I think so far as we look at things here, like the Western Corn Belt, looking at the basis out here, I know of several areas in central Iowa, eastern Nebraska, and even central Nebraska here. If you have corn to ship this week, there are elevators paying upwards of $7.50 right off the combine. Get it here now. And there's feed yards out there that are bidding par with these futures as far as wet corn. There's some places you get even further west out in the Corn Belt there where they had the dryness in Kansas, western Kansas, southwest Kansas. The basis out there is really carrying it. You can get upwards, some are saying upwards of $8 a bushel right off the combine for wet corn, no dock. So looking at this market, I do agree though, with the way that this thing is structured, we could see some more harvest pressure come in here as we really get the combines rolling in here next week. But I think it's going to be area specific, and you as a producer probably need to be looking at your local basis where you market grain, for the big picture outlook. If you are in a deficit area, it may work for you to store some grain. However, there is no carry out there. You'd be strictly looking at basis appreciation there. So it really is going to be area specific as far as corn, whether you sell it, which the market's telling you to sell it up front now because there's an inverted market. DC is trading over July. So the market's still telling us right now, as we sit here today, they want your corn now off the combine.
Now let's go back to more of a macro market picture here. And of course, interest rates have been one of the hot topics throughout this week. The Federal Reserve has been primed to continue raising U.S. interest as it battles inflation. With that, though, it's having a direct impact to the currency exchanges, and the U.S. dollar index continues to hold well above its 20-year high mark, pushing back into the 111 handle this week. So that's definitely caught a lot of traders' attention, and it's also impacted global currency markets. We saw the Japanese yen head for 20-year lows, and for the first time in nearly a quarter of a century, Japan had to step back in, dump its dollars, move back into its own currency there with the yen as well. So, Brian, I direct this one to you first, but when we're looking there, exports were less than stellar this morning. How big of an impact right now is this dollar having, and how much export demand anyway, is this holding back for us?
Yeah, so we're not getting the typical relationship that we would look for, which is strong dollar, weak commodity futures, but we are seeing it on the demand side. Like you'd mentioned, corn exports are surely suffering. When you look at the uptrend in the dollar, and some of the measurements I'm looking at on some of these longer term weekly and monthly charts would suggest that upside targets could be as high as 117 to 120. If we do see a move like that, I think you're going to continue to have a problem with exports out of the country. And then when you think about soybeans, you've got a lot of the Argentine crop has been sold recently. China has picked up quite a bit of that. And then you think about the risk of a large Brazilian crop this year, and it'll all boil down to whether or not this La Nina decides to back off, or if we do have a third La Nina in a row. But we have to realize that with the acreage potential down there and good weather, if that's what comes to fruition, we're going to have a 150 plus million ton crop. And the risk of really seeing our soybean exports, especially because of how front-end loaded our export program is right now, our exports could fall off the cliff here as we get into 2023. And that's going to be something to be mindful of for not only the crop that you're growing right now, but I think more importantly, these November 23 futures as we continue to find resistance against $14.
It's definitely a lot to keep in mind there. Kyle, I'm going to pose this, but I'm going to go over to your more livestock-driven background. When you're looking at this higher dollar, and then you look at a country in particular like Japan, South Korea, both of those important to our beef and pork trade. They're major importers of U.S. protein products. How is this currency impacting over on the livestock side of the trade?
Well, I think it's going to affect us, obviously, with that export market there. Now, our so far, looking at this morning's numbers here, or Thursday morning's numbers here, last week we were down 4% from last year on the beef exports, and our year-to-date pace is, I believe, 1% below last year. So USDA estimates we'll end up 3.5% above a year ago, but right now we're behind that USDA forecasted pace. So we do definitely need to pick it up, and the higher dollar is really not going to help things. Couple that with, as you've mentioned here, with the economy as it is, people may start backing away from the meat counter a little bit if this box beef stays too high.
So there's a lot to keep in mind there, especially when it comes back to where that is. But it looks like the choice cutout, the select, it's all holding fairly firm. And we'll get to this in just a minute in that cash cattle market. But it looks like packers are chasing a little premium. And there, I'm going to go ahead and open it up into our livestock discussion. Coming here into the end of the week, cattle are under some significant pressure on the future side of the trade. And Kyle, I'm going to take this one to you first. I know you watch those technicals quite closely. Are we in liquidation mode here when it comes to those feeders, and how much of that's spilling over to the live cattle?
Well, it does appear that we are in a liquidation mode here in this feeder cattle complex. Now, what's interesting to note here on Thursday, mid to late morning, we did see the front 3 months of feeders kind of meet up here with the index. So that's something that needs to happen here. This index market, the cash market does need to pick itself up, or the futures need to come down. As I've said many times, that there's just a lot of premium out there in those deferred contracts. And that's been probably one of the most bearish forward curves we've had, has been the feeder cattle complex for quite some time. Looking over here at the live cattle complex, same kind of situation here. We've got a lot of premium built out there. And if we're worried about the demand in grains, we just look at the cattle complex and say, well, there's plenty of cattle out there right now. So for now, that does support the grain demand from the feed side of things. But technically, these December live cattle have major support down here on this 149.38 to 149.40 area. That's going to be a potential new 4-week low. And we also have a 100-day moving average out there. Today, we closed below the 50 average. That's the first time we've closed below that in quite some time. So it's definitely worth noting. If we start to take out some of these technical support levels, we could see these non-commercials, which have the last few weeks build up a sizable long position, we could see them start to liquidate the live cattle side of things. And then if we really are short on this feeder cattle complex, we could see that rubber band disposition as they've been liquidating and going short the feeder cattle complex. We could see that snap back together, and we could see the non-commercials come back into feeders if this cash market starts to pick itself up and they say, maybe we are a little short on feeders. Maybe we need to own some of those too.
Brian, I'll take this question back over to you. We've talked live cattle, feeder cattle. There's still the lean hog complex as well. Are we near any major areas of support where we're kind of at a battleground for the bulls to try and keep a hold of this market? Or are we starting to inch over towards the bearish side?
Well, I'll talk about lean hogs real quick, but I think there's stuff that we still need to mention on feeder cattle. We've confirmed a head and shoulder top on feeder cattle October, November. That's in place. That's confirmed. I think that's going to weigh on live cattle. Live cattle has a double top. December live cattle had a high contract high made 5 months ago. Almost exactly 5 months to the day, we trade up there and make a double top. And if we take out 148, we're going 144 there on D's live cattle. Now, when I look at the lean hogs, we're potentially looking at a head and shoulder top there, just potentially making the right shoulder recently. And if we see this D's lean hog contract get below 80, that projects back down around 71. So one of the things that we've been looking at in our technical webinars that we do every Wednesday is the charts and why cattle producers should own 148 puts. They were going for just over $2 yesterday. Why producers should be looking in lean hogs at 80 to 82 strike price puts. Those were going for about $2 yesterday. This is very cheap protection. And you have to think that if the stock market, which is going to have some impact on the perception of the demand for beef and the money flow in general, if we see the stock market end up taking out June lows, I think you're going to see the protein market in general take a hit. And so with the uptrend around 148 in D's live cattle, that solidifies to me why we need to have protection at these levels.
And again, as Brian Splitt with agmarket.net, Kyle Bumsted also joining us on this week's Nebraska Soybean Board's weekly commodity wrap-up. And for Susan Littlefield, I'm Clay Patton. Do remember, trading futures and options involve a substantial risk of loss and may not be suitable for all investors. Consider these risks before investing.